All right, let's talk about Workday. We're going to try and solve a real head-scratcher here. You've got a business that on paper looks like an absolute fortress. But then you look at the stock, and it's been a total train wreck. So what is going on? Is the business broken, or is the stock broken? Let's figure it out.
Okay, let's just start with this brutal chart. I mean, look at this. Since 2020, the NASDAQ, the tech-heavy index, it's soared over 75%. Meanwhile, if you were a Workday investor, you were on a very different ride, losing almost half of your money. That gap you see there is just massive. It's the kind of thing that makes you ask, what on earth could justify this level of destruction? Seriously, if you find these kinds of market puzzles as fascinating as I do me a favor and hit that like button. It really helps us out.
So to really get what's happening, we have to ignore the stock price for a minute. Let's just push it to the side and look under the hood at the actual business. Is the engine sputtering and dying, or is something else going on here?
Well, first things first, this is not a shrinking company. Not even close. You can see right here, revenue growth has just been this beautiful, steady upward climb. It's more than doubled in just 5 years, hitting nearly $8.5 billion. We're talking about a compound annual growth rate over 18%. That is just relentless. Now this slide. This is where things get really interesting. Check out that gross margin, a stunning 75.5%. So what does that mean? It means for every single dollar Workday makes, they get to keep over 75 cents to run the business and, hopefully make a profit. That is an absolutely elite number. It's like having a fortress around your business, and it screams that they have serious pricing power.
And they've finally solved the profitability puzzle. For years, Workday was that classic tech story, right? Growth, growth, growth at all costs, burning through hundreds of millions of dollars. But look at that chart. See that flip? They hit a major inflection point and are now earning over $1.3 billion. The days of bleeding cash for growth are over.
And this right here, this might be the strongest argument for the bulls. People call free cash flow the truth serum for a business because you can't really fake it. And for Workday, it's in a tidal wave of cash. It's more than tripled to almost $2.2 billion. That is pure, raw fuel for whatever they want to do next.
And if all that wasn't enough, the balance sheet is just a rock. They're sitting on over $8 billion in cash. They only have about $3.3 billion in debt. That means they have a net cash position of almost $5 billion. The risk of this company going bankrupt is, for all intents and purposes, zero. So let's just recap, right? Revenue is doubled. Margins are huge. They're profitable. They're gushing cash. And they have a bulletproof balance sheet. The business case looks absolutely incredible. So, here it is, the big question. What are we all missing? There's got to be a catch, right? To find out what's been secretly punishing investors, make sure you're subscribed so you don't miss deep dives like this one. Okay, let's flip the coin. We've seen the good stuff. Now let's look at the other side of the ledger, the things that have been hammering shareholders and causing that ugly stock chart we saw at the start.
And here it is. This is the silent killer for so many tech stocks, shareholder dilution. See, to get top talent without draining all their cash, Workday pays its people with stock. That means the total number of shares out there has gone up by almost 17%. Think of it like a pizza. Even if the pizza itself gets bigger, if they keep adding more and more slices, your personal slice just keeps getting thinner.
On top of that, there's the price tag. Now you'd think after a massive drop like this, the stock would be a bargain, right? Nope. It's still trading at a price-to-earnings ratio of over 47. The average for the market is usually around 20, maybe 25. So you're still paying a premium price that basically assumes everything is going to go perfectly. There is just no room for error. But there is a new twist in the story. It looks like management is finally starting to fight back. For the first time ever, they've started a pretty big share buyback program. They've already spent over $500 million buying their own stock. This does two things. It directly fights that dilution we talked about, and it's a huge signal to Wall Street that management thinks their own stock is cheap.
So here we are. How do you weigh these two things? You've got this amazing, high-performing business on one side, and these really painful headwinds for shareholders on the other. So here's the whole story in one slide. The bull case is simple. Business is booming, cash is flowing, the balance sheet is a rock, and now they're buying back stock. The bear case is just as clear. The stock has gotten hammered, you're being diluted, it's still not cheap, and the momentum is just terrible.
So here's our final verdict. It looks like Workday is a fundamentally fantastic business that's just trapped in a really, really negative cycle of bad feelings in the market.
This huge split between how the business is doing and how the stock is doing, well, that could be a huge opportunity. But that valuation is still a risk, and it absolutely demands that they keep growing, and growing strong.
So now I got to turn it over to you. You've seen both sides of the coin. What's your verdict on Workday? Drop it in the comments below. I'd love to hear what you think. And hey, if there's another company you're scratching your head about and want us to put under the microscope, let us know which one to tackle next.
So we'll leave you with that one final question to chew on. Is this one of those generational buying opportunities, a chance to get a great business that's been unfairly beaten down? Or is it a classic value trap where the headwinds are just too strong? Thanks so much for watching.